There is a sequence to how monetary crises unfold that almost no one understands until it is too late to act on the understanding. The sequence begins not with a headline, not with a press conference, not with a market crash visible on any retail brokerage screen. It begins with a decision made in a room that most people have never heard of, by institutions most people cannot name, operating on a time horizon most people cannot emotionally process. The decision propagates through the system, slowly at first, invisibly at first, registering in the price of a single asset that most people do not watch, cannot interpret, and have been conditioned to dismiss as a relic of a previous era. And then, months or years later, the public learns what happened. The public is always last. Gold is not last. Gold is first. Gold is the instrument through which the most informed, most deliberate, most structurally aware capital on earth communicates its judgment about systemic changes before those changes are visible in any other price. It does not speak in press releases. It speaks in price. And what it is saying right now, in this specific configuration, with this specific buyer profile, against this specific macro backdrop, is a message that the public has not yet heard, but that sovereign institutions have been reading clearly for more than 2 years. The OPEC decision that broke the system did not make the front page of the financial press. No single OPEC decision does anymore. They have been normalized, categorized, filed under energy news, and forgotten within a trading week. But there is one decision, or rather a series of decisions accumulating into a single structural rupture that represents something categorically different from a supply management adjustment. It represents OPEC's formal, operational, and now irreversible departure from its implicit role as the demand support mechanism for the dollar system. That departure has consequences that extend far beyond the oil market. Gold saw them before the public did. And in the next 25 minutes, I'm going to show you exactly what gold saw, why it matters, and what the historical record tells us happens next to the people who understood this early and the people who understood it late. Stay with me, because I am going to give you 3 things. First, the specific OPEC decision that broke the system, not the one that made the headlines, but the one that restructured the foundational relationship between oil, the dollar, and sovereign capital flows in a way that cannot be undone. Second, the mechanism by which gold reacts before the public, not as a matter of mysticism or market magic, but as a precise institutional process involving the most informed buyers in the global financial system, whose behavior follows a logic that is knowable, traceable, and currently in motion. Third, what the historical record shows happens in the period between when gold reacts and when the public understands why, the window we are currently inside, and what that period has historically meant for wealth positioning on both sides of the divide. I want to be honest with you about the nature of this analysis. I am not predicting a date. I am not predicting a price target. I am describing a structural process that is already underway, already documented in the reserve data of over 40 national institutions, and already visible in the behavior of the most consequential commodity market in the world. The people who understand this process do not need a prediction. They need a map. That is what I intend to give you. To understand what OPEC broke, you first need to understand what OPEC was protecting, not voluntarily, not through any formal agreement, but structurally, through the architecture of an arrangement that has governed global monetary flows since the mid-1970s. The petrodollar system, the arrangement by which oil is priced, sold, and settled in dollars, did not emerge from idealism. It emerged from a specific geopolitical negotiation in 1974 between Henry Kissinger, representing the Nixon administration, and the Saudi leadership, operating in the aftermath of the 1973 oil embargo. The core of the arrangement was straightforward. Saudi Arabia would price its oil exclusively in dollars and would invest its surplus oil revenues in U.S. Treasury securities and other dollar-denominated assets. The United States would provide security guarantees, weapons access, and political support. Every other OPEC member, following Saudi Arabia's lead, adopted the same dollar pricing convention. The consequences of that arrangement for the global monetary system were profound and are still not fully appreciated in mainstream financial commentary. Because oil is the foundational energy input for every industrial economy on Earth. The dollar pricing of oil created structural, non-discretionary demand for dollars in every oil-importing nation. Japan needs oil. To buy oil, Japan needs dollars. The same logic applies to Germany, to India, to South Korea, to Brazil, to every economy that runs on energy. It does not produce in sufficient domestic quantities, which is most of them. This structural demand for dollars is what economists call the exorbitant privilege in its most concrete form. The United States could run persistent trade deficits, could consume more than it produced, could borrow more than it saved, because the world was structurally compelled to absorb the resulting dollar supply. The world needed dollars. The United States provided them. And the surplus dollars that accumulated in oil-exporting nation reserves flowed back into Treasury bonds, suppressing American borrowing costs and sustaining fiscal expansions that would otherwise have been disciplined by the bond market. This system is not a conspiracy. It is a structural equilibrium, a self-reinforcing loop in which each participant's rational behavior sustained the whole. America ran deficits because it could. OPEC priced in dollars because that maintained the arrangement with America. Oil importers accumulated dollars because they had no alternative. Dollar surpluses recycled into treasuries because that was the deepest and most liquid market available. And the loop completed itself, quarter after quarter, decade after decade, sustaining the dollar's structural primacy through the accumulated force of institutional habit and economic necessity simultaneously. Here is the part most people miss. The loop has a vulnerability. It has exactly one vulnerability, and that vulnerability is not economic. It is political. The loop survives as long as its participants, particularly the largest oil producers, continue to find the arrangement more beneficial than the alternatives. The moment that calculus shifts, the moment the largest participants in the loop begin to explore and operationalize alternatives, the structural demand for dollars that the loop generates begins to erode. Not overnight, not catastrophically, but directionally, persistently, and, once started, with a momentum that is very difficult to reverse. OPEC's accumulated decisions since 2022, the production cut against American wishes, the yuan oil trades, the acceleration of bilateral settlement arrangements, the visible reassessment of the security architecture that sustained the original 1974 arrangement, but crossing of exactly that threshold. Not all at once, not formally, but functionally. Let me be precise. Saudi Arabia, which anchors the petrodollar arrangement and whose participation is the structural prerequisite for its continuity, has in the past 3 years demonstrated 4 things simultaneously that represent a categorical departure from its prior posture. It has demonstrated willingness to make production decisions that directly conflict with American economic interests. It has demonstrated willingness to settle oil transactions in currencies other than dollars. It has demonstrated willingness to deepen strategic and economic relationships with China, the United States' primary geopolitical competitor, in ways that include energy cooperation agreements, security dialogues, and diplomatic normalization with Iranian interests that Washington opposed. And it has demonstrated willingness to allow the physical infrastructure of alternative settlement, the yuan payment systems, the bilateral clearing arrangements, the financial architecture of a non-dollar oil market, to be built and tested during a period when it could still be reversed, which is precisely the precondition for making reversal politically unnecessary later. None of these individually would be decisive. Together, they constitute a strategic repositioning of the anchor participant in the petrodollar system away from its role as the demand support mechanism for dollar primacy. The system is not broken because OPEC abandoned the dollar. The system is broken because OPEC demonstrated operationally and repeatedly that abandonment is possible, that the architecture of an alternative exists, that it functions, and that the political will to use it at larger scale is present and growing. That is a different kind of break from what most people imagine. It is not a rupture, it is a fracture, invisible from the surface, structural at the foundation, and propagating through the system in a way that gold was measuring before any other instrument registered the movement. Now let us turn to the mechanism, because this is the part that most people get wrong about gold's behavior, and getting it wrong means they consistently misread what gold is saying, until it is too late to act on the message. The popular understanding of gold is that it rises during crises, that it is a fear asset, a flight to safety instrument, something investors buy when they are scared and sell when their confidence returns. That understanding is not wrong, but it describes only the surface behavior, the retail layer of gold market dynamics, and it misses almost entirely the deeper institutional layer that determines the long-cycle direction of gold's price. The deeper layer is central bank behavior. And central bank behavior in the gold market follows a logic that is fundamentally different from retail or even institutional investment behavior. Central banks buy gold not because they are afraid of the next quarterly earnings season. They buy gold because they have made a multi-year, multi-decade assessment of the monetary architecture, the structural reliability of the instruments they hold as reserves, the political and institutional risks attached to those instruments, and the long-cycle trajectory of the system in which those instruments exist. Their buying decisions are made slowly, implemented over months and years, and are not reversed by quarterly data or short-term market fluctuations. When a central bank adds gold to its reserve portfolio, it is making a generational statement about the monetary system's direction. Here is what matters. Central banks have access to information and analytical capacity that no retail investor and very few institutional investors can match. They employ economists who study these long cycles professionally. They have access to classified geopolitical assessments. They participate in the Bank for International Settlements deliberations, where the structural condition of the global monetary system is analyzed with a depth and candor that does not appear in public communications. They are, in a very specific and measurable sense, the most informed participants in the global financial system, and they have been buying gold at the highest pace in 50 years. Write this down. When the most informed participants in the global financial system make their most deliberate, least reversible, most structurally significant portfolio decisions, and those decisions consistently, across more than 40 sovereign institutions simultaneously, point in the same direction as Satanamo. Fada direction is not random, it is signal. It is the most reliable long-cycle signal in macro investing, and it is currently pointing toward gold with a consistency and a scale that has no precedent in the modern era of floating exchange rates. The mechanism by which gold reacts before the public is therefore not mysterious. It is institutional. The central banks that have been buying gold since 2022 are not reacting to OPEC's decisions in the way a retail trader reacts to a headline. They have been anticipating the structural consequences of the petrodollar system's erosion for years, in some cases for decades, and they are implementing their response, deliberately, quietly, persistently, through the accumulated purchasing decisions that show up in the World Gold Council's quarterly data and in the reserve composition tables published by the International Monetary Fund. The public learns about this buying after the fact. The public reads the quarterly data months after the purchases were made, interprets it through a framework that emphasizes the price movement rather than the institutional logic behind it, and typically concludes that gold has already risen and therefore the opportunity is past. That conclusion is always wrong at the same point in the cycle. It is wrong because the institutional buying that drives long-cycle gold appreciation does not front-run itself. The central banks buying gold today are not buying because they expect the price to rise next quarter. They are buying because their structural analysis of the monetary system tells them that the next decade, the long middle of the reserve currency transition, the period of persistent dollar erosion, of fiscal stress, of declining petrodollar recycling, is a period in which hard, counterparty-free, politically neutral reserve assets will perform their function better than the alternatives. Their time horizon makes their buying patient. Their patience means the buying continues long after the initial catalyst. And the continuation of that buying quarter after quarter, regardless of short-term price movements, is the structural foundation of the long cycle we are inside. Let me be precise about where we are in that cycle. Central bank gold holdings as a percentage of total global reserve assets remain below the levels that prevailed during the Bretton Woods era. The directional move toward gold has been underway for several years and has significantly elevated prices from their prior levels. And yet the structural logic that drives the buying, the petrodollar erosion, the fiscal arithmetic, the geopolitical fractures, has not been resolved. It has intensified. The buying is not at a peak. It is in a sustained trend with structural momentum that the underlying conditions continue to reinforce. That is the position the public has not yet reached. That is the window that remains open. If you have been waiting for a framework that explains gold's behavior at the structural rather than the surface level, and if this is the kind of thinking you want more of, subscribe now. We build this analysis systematically, and the conversation continues. Now let us turn to the historical record, because this is where the analysis becomes most directly useful to anyone thinking seriously about the decade ahead. In every prior instance in which a major reserve currency began its structural transition, in which the foundational relationships that sustained its primacy began to fracture at the sovereign level, there was a period between when the informed institutions began repositioning and when the broader public understood what was happening. I call this the recognition gap. And the historical record of that gap is both instructive and sobering. During the final decade of sterling's reserve currency primacy, the 1940s, when the Bretton Woods architecture was being constructed and the dollar was formally displacing the pound, holders of sterling-denominated wealth who understood the transition early preserved capital by converting into dollar assets and gold. Holders who waited for the public consensus to form, who needed the explicit confirmation that sterling's primacy had ended before they were willing to act, found that by the time the confirmation arrived, the conversion had already been priced. The opportunity had been in the gap. During the 1970s dollar crisis, the decade of oil shocks, stagflation, and the progressive destruction of the fixed exchange rate architecture that Nixon had dismantled, gold rose from $35 per ounce to over $800. The investors who captured that movement were not the ones who bought when it was obvious. They were the ones who understood in the early years of that decade that the removal of gold convertibility had fundamentally altered the monetary architecture in ways that would eventually be expressed in the price of gold, regardless of the Federal Reserve's intentions, regardless of the administration's wishes, regardless of the consensus that confidently expected stability to be restored. The pattern is consistent. The recognition gap, the period between institutional understanding and public understanding, is the window. It is where the positioning opportunity exists, and it closes in one of two ways. Either gradually, as the structural reality becomes visible enough that the consensus catches up, and the price moves to reflect widespread recognition, or suddenly, when a catalyst compresses the timeline and the public scrambles to understand a repricing that has already substantially occurred. Here is where the current moment becomes specific. The recognition gap for the petrodollar erosion story is not small. Most retail investors, and honestly most financial professionals operating in the traditional equity and fixed income space, have not integrated the structural reality of what OPEC's accumulated decisions mean for the dollar system, what the sovereign gold buying means for the monetary architecture, what the fiscal arithmetic of 30+ trillion in debt plus declining petrodollar recycling means for the trajectory of American borrowing costs. They see the gold price, they see it high and rising, and they reach for the nearest simple explanation, inflation hedge, fear asset, speculative momentum, that fits their existing framework without requiring them to update that framework's foundations. The simple explanations are not wrong. They are insufficient. They describe the surface without the structure. And investing on surface descriptions of structural processes is how wealth gets preserved adequately in the middle of a transition and catastrophically misallocated at the transition's most consequential moments. Let me be precise about what the historical record shows happens when the public finally catches up to the recognition that the sovereign institutions expressed years earlier. It shows a compression of the prior trend, a rapid movement in gold prices and dollar-denominated asset valuations that reflects not just the new information being processed, but the adjustment of all the positions that were maintained on the basis of the prior, now invalidated framework. That compression is not the beginning of the opportunity. It is the end of it. The opportunity is now, in the gap, while the structural reality is visible to anyone willing to do the analytical work, but not yet priced into the consensus. Let us bring these three threads together into the synthesis that makes the full picture coherent. OPEC broke the system not through a single dramatic act, but through the accumulation of decisions, each individually explicable as an energy market adjustment, collectively representing the fracturing of the foundational relationship that has sustained dollar primacy for 50 years. The petrodollar loop that compelled every oil-importing nation to generate structural dollar demand that recycled oil surplus back into Treasury bonds, that suppressed American borrowing costs and sustained American fiscal expansion. That loop is being operationally disrupted by the very participants whose continuous participation was its precondition. Gold reacted before the public because gold's price in this cycle is being driven not by retail fear or institutional momentum, but by sovereign accumulation, by the deliberate, structurally informed, multi-year reserve portfolio decisions of central banks that have done the analysis, reached the conclusion, and are implementing the response in the only language that matters, the language of purchase. They are buying what cannot be sanctioned, cannot be inflated away, carries no counterparty, and has served as the monetary reserve of last resort in every prior transition of the kind we are now inside. And the historical record of what happens between the institutional recognition and the public recognition of reserve currency transitions is unambiguous in its directional implication, even as it is appropriately humble about precise timing. What unites all three threads is the recognition gap itself, the space between what the most informed institutions have already priced and what the broader public has not yet understood. That gap is the map. It does not tell you the exact route, but it tells you the direction, the terrain, and the general scale of what lies ahead for those on either side of the divide. I want to close with something that I believe is the most practically important insight I can offer on this subject. More important than any specific price target, any specific timeline, any specific geopolitical catalyst. The public is always last. That is not a statement of contempt. It is a structural description of how information moves through financial systems. The institutions with the most information, the longest time horizons, and the most sophisticated frameworks act first. The secondary institutions, reading the signals from the primary actors, act second. And the public, working from headlines, from the conventional wisdom of their financial advisors, from the simplified narratives of mainstream financial media, acts last. Acting last in a monetary transition does not mean losing everything. It means losing the optionality. Losing the chance to position before the repricing rather than after it, to hold the asset that benefits from the transition rather than the asset that suffers it. To be on the right side of a generational restructuring of monetary values, rather than scrambling to understand it after the restructuring has substantially occurred. OPEC has broken the system. The break is structural, it is documented, and it is being reflected in the reserve portfolio decisions of sovereign institutions on every continent. Gold has already reacted. The price is the evidence, and the buyer profile behind the price is the interpretation. The public has not yet reacted. The public is reading energy news, following the equity market, checking inflation prints, and waiting for the kind of clear, dramatic, undeniable signal that monetary transitions do not provide. Because by the time a monetary transition is clear, dramatic, and undeniable, the signal is also well past its most actionable moment. The people who understand what OPEC broke and why gold reacted before the public and what the historical record shows happens in the gap between those two moments. Those people are not watching in the news for permission to act. They are already positioned. They are already inside the asset that has served as the bridge between one monetary order and the next across every transition in the last 5,000 years of human civilization. The question before you is not whether the transition is happening. The data is unambiguous. The question is simply which side of the recognition gap you intend to be on when it closes. Gold already gave you its answer. It gave you that answer before you heard the question.